Thank you for being here today. We live in a world of uncertainty, geopolitical tensions, rising debt, shifting economic cycles, and fast-moving technology. In such times, it's wise to look at investment frameworks that emphasize resilience and diversification. Drawing from his principles, I'd like to walk you through 10 investments that reflect my philosophy, investments that could help build a robust portfolio as we head into 2026. Here are the 10 investments, grouped by themes tied to my core ideas, along with why they matter and how they fit into a diversified all-weather strategy. Intermediate-term bonds, the stability buffer. In my all-weather portfolio, intermediate-term bonds, typically U.S. Treasury bonds with maturities in the 7 to 10-year range, play a highly strategic role. While long-term bonds help protect against deflation and provide a strong safe haven in downturns, and equities drive growth, intermediate-term bonds act as the stability buffer between those two extremes. Linked into tradingbrokers.com too. First, intermediate-term bonds offer moderate interest rate sensitivity. They are less volatile than long-term bonds, so when interest rates fluctuate, they don't swing as wildly in price. This makes them a more stable fixed income component, especially in environments where rates are uncertain or maybe rising. Linked into plus Saxo Bank plus 2, because they don't react as aggressively to changes in interest rates. They help cushion the bond sleeve of the portfolio, giving it balance and reducing interest rate risk concentration. Second, these bonds generate reasonable yield compared to shorter-term bonds. Intermediate-term ones tend to offer better yield without pushing too far into long-duration risk. That yield provides a steady stream of income, which can be reinvested or used to fund other parts of the portfolio. Third, intermediate-term bonds contribute meaningfully to Dalio's risk parity philosophy. In risk parity, each asset class aims to contribute roughly equally to the total risk of the portfolio, rather than just being allocated by capital. By having a portion in these bonds, Dalio ensures that part of the bond allocation isn't overly dominated by long-term bonds, which are more sensitive to rate moves and have higher duration risk. Superpower thinking plus one. Fourth, from an economic regime perspective, intermediate-term bonds are versatile. According to my framework, they perform well in low-growth, low-inflation environments, a scenario where the economy is sluggish, but inflation isn't rising aggressively. Portfolio Crunch 2 plus Saxo Bank plus 2 in such seasons, they help stabilize the portfolio by providing income and reducing drawdowns without exposing the investor to the full duration risk of long-term bonds. Finally, the inclusion of intermediate-term bonds enhances portfolio resilience and flexibility because they don't react as sharply to rate changes. They allow a smoother glide path when markets are volatile. This means the portfolio can better absorb shocks and rebalance more predictably. In some, intermediate-term bonds in my all-weather mix act as a crucial bridge. They deliver income, moderate risk, and contribute to the balanced risk contributions across economic cycles. Their role is not flashy, but it's foundational. They help make the portfolio robust, steady, and able to weather a broad variety of economic environments. Gold is a strategic hedge. Among all the asset classes I frequently discuss, gold holds a uniquely important role. I often emphasize gold as a form of protection, not a speculative bet, and I frames it as a historical defense mechanism against the eroding forces that threaten financial assets, such as inflation, excessive debt, currency devaluation, and geopolitical conflict. To me, every strong portfolio should include hedges against the unexpected, and few assets have proven as consistently resilient across centuries as gold. Gold's importance comes from the fact that it is not tied to the performance of any single country, corporation, or government policy. It has intrinsic value recognized globally, making it an asset that does not rely on trust in political stability or monetary soundness. When confidence in financial systems declines because of money printing deficits or global tensions, gold often becomes more attractive. One major reason I appreciate gold is its role as a hedge against monetary inflation and currency depreciation. When governments face large debts or economic slowdowns, they often rely on lowering interest rates or increasing the money supply. While this can stimulate the economy in the short term, it usually leads to weaker currencies and higher prices over time. Because gold cannot be printed or manufactured at will, this scarcity preserves its purchasing power even as fiat currencies lose their strength. Gold is also valuable in a portfolio because it helps maintain true diversification. Many investors believe they are diversified simply because they hold many different stocks, but those stocks may all react similarly during a crisis. Even bonds can lose value if interest rates spike unexpectedly or if investors begin to worry about the creditworthiness of governments. Gold, however, tends to move independently from traditional financial markets. This makes it particularly useful during tail risk events, moments when things go very wrong and other assets fall together. I often refer to gold as a risk-off safe haven during such times. Another major reason gold fits into my philosophy is its performance in major macroeconomic regime shifts. History shows that gold experiences large upward movements during periods of high inflation, rapid currency debasement, debt crisis, war or geopolitical instability, loss of confidence in governments or central banks. My studies long-term cycles, especially the rise and decline of world powers, and notes that gold has repeatedly served as a store of wealth when global power dynamics shift. When uncertainty about the future of reserve currencies or global leadership grows, investors often turn to gold. Gold can also be considered a form of insurance. Just as people insure their homes not because they expect a fire, but because a fire would be devastating, investors own gold for the possibility of a rare but damaging financial crisis. Holding some gold can reduce a portfolio's maximum drawdown, meaning investors lose less during turbulent times and recover more quickly once stability returns. Finally, gold's practical liquidity makes it even more attractive. It can be easily bought or sold around the world, meaning investors can convert it to cash when an opportunity or emergency arises. Some investors extend this theme into other precious metals as well, but gold remains the most widely respected conclusion. My emphasis on gold is rooted in realism. It is not about predicting catastrophe. It is about preparation. Gold does not depend on perfect economic conditions to preserve value. Instead, it thrives exactly when other assets struggle. By including gold in a portfolio, investors do not simply seek profit, they build resilience. In a world filled with uncertainty, gold provides stability, balance, and the confidence that one's wealth has a timeless anchor. Commodities to protect against inflation. Commodities play a crucial role in my investment because they provide protection against one of the most persistent financial risks investors face, inflation. When prices rise across the economy, whether due to supply shortages, rising demand, or monetary expansion, the cost of essential goods like energy, food, and raw materials increases. Commodities are the direct inputs to these goods and services, which means that when inflation rises, commodity prices typically rise as well. In this way, commodities act as a natural hedge. While inflation reduces the purchasing power of cash and can hurt traditional financial assets, such as stocks and bonds, commodities usually move in the opposite direction. My all-weather approach includes commodities not to boost returns in good times, but to stabilize the portfolio during inflationary shocks, scenarios when other asset classes may struggle. Commodities also reflect real-world supply and demand dynamics. For example, energy commodities like oil and natural gas are essential to transportation and industry. When economic activity grows, demand for these sources often rises. Similarly, industrial metals such as copper and aluminum benefit from infrastructure expansion, while agricultural commodities support global food needs regardless of market conditions. This utility-driven value helps sustain commodities through different economic phases. Moreover, many commodities are influenced by geopolitics and environmental change, factors that can disrupt supply and drive prices higher unexpectedly. Instead of viewing that volatility as a risk, I sees it as portfolio protection, because those same events often hurt equity and bond markets. Overall, commodities serve as an inflation shield and a diversification enhancer. Their presence in a balanced portfolio helps ensure that even as financial markets shift due to inflationary pressure, the investor maintains exposure to assets that can rise in value and preserve purchasing power. Equities for growth in my investment framework. Equities stocks are the primary engine of growth, while bonds, gold, and commodities help protect a portfolio against risk and inflation. Equities unlock the potential for wealth creation over time. They represent ownership in companies, businesses that innovate, expand, and generate profits. As economies grow and productivity advances, equity investors share in that rising value. My perspective on equities is shaped by his study of long-term economic cycles. Historically, despite recessions, wars, political change, or market crashes, global stock markets have shown strong upward performance over decades. This is because human progress continues, better technology, smarter production methods, and growing global consumption. I often emphasize that productivity improvements are the greatest driver of wealth over generations, and equities are the clearest way for investors to participate in that growth. However, I am equally aware that stocks can be highly volatile. They are sensitive to interest rates, inflation, corporate earnings, and investor sentiment. Because of this, equities are not meant to carry the whole portfolio. Instead, they occupy a balanced role within a diversified structure, ensuring investors benefit from growth without taking on more risk than necessary. Within equities, Dalio typically spreads exposure across developed markets. These include major stable economies like the United States, Western Europe, and Japan. The U.S. especially has demonstrated strong leadership in technology, innovation, and corporate profitability. Developed market equities provide reliable long-term growth from companies with global reach. Two emerging markets, countries such as China, India, and Southeast Asian nations, represent regions where populations are expanding, incomes are rising, and modernization is accelerating. Dalio has expressed particular focus on China given its scale and economic evolution. Emerging markets can deliver higher returns, but they also carry more risk. That's why they complement rather than replace developed market exposure. 3, innovation and sector leadership. Dalio recognizes that not all sectors grow equally. Industries driven by technological transformation, like artificial intelligence, automation, digital infrastructure, and biotechnology, can generate outsized returns. While Dalio avoids speculative bets, he invests in structural trends that reshape economies and unlock future productivity. Why equities matter in Dalio's strategy. Equities thrive in environments with rising productivity, healthy corporate profits, stable or falling inflation, supportive central bank policies. These conditions often occur during times of economic expansion, which form a key part of the economic cycle. Yet I does not rely on predicting when expansions will occur. Instead, I create a portfolio with continuous exposure to equities so that growth periods automatically reward the investor. My all-weather model ensures equities drive returns when the world is progressing, while other assets protect the portfolio when the world struggles. In essence, equities represent optimism and opportunity, confidence in creativity, entrepreneurship, and global progress, managing equity risk, because equity markets can experience sharp declines. Dalio respects risk management. I spread investments geographically. I includes defensive assets like bonds and gold. I limits equity allocation to maintain structural balance. This prevents market corrections or bear markets from threatening long-term goals. Dalio often reminds investors, diversification is the most important principle of investing. Equities offer the upside, but diversification ensures the investor survives the downside. Conclusion, equities are a vital pillar of my investment philosophy because they allow investors to participate in the growth of the human economy. They represent innovation, progress, and expanding wealth. But my approach is equities strategically, never relying on them alone, but integrating them into a portfolio designed for any economic environment. By balancing equities with defensive and inflation-proof assets, I shows that successful investing is not about betting on one future. It's about building a portfolio strong enough to thrive in many. When used wisely, equities fuel the journey toward long-term financial success. Risk parity is central. At the heart of Ray Dalio's investment strategy is the concept of risk parity, a method of balancing a portfolio so that each asset class contributes equal risk rather than equal capital. Dalio observed that most traditional portfolios are heavily weighted toward equities. Even if stocks represent only 50 to 60% of capital, they may account for more than 80 to 90% of the total risk. This creates a portfolio that performs well only when the stock market rises, but becomes highly vulnerable during downturns. Risk parity solves this problem by spreading out risk exposure, not just investment dollars. For example, while equities inherently carry more volatility, bonds and commodities generally carry less. To equalize their contribution, the portfolio may include a larger allocation to lower risk assets, helping offset the dominant influence of stocks. This approach allows the portfolio to perform more consistently across different economic cycles, whether growth is rising or falling, or inflation is high or low. Dalio designed the all-weather portfolio using this principle so that no single asset and no single economic scenario can make or break the investor's success. Risk parity, therefore, isn't just a diversification technique, it is a portfolio resilience strategy, ensuring long-term stability and sustainable performance. True diversification requires uncorrelated assets. Ray Dalio emphasizes that diversification only works if the assets in a portfolio do not move together. Many investors believe they are diversified simply because they own multiple stocks or mutual funds. However, if those assets are all influenced by the same economic forces, such as corporate earnings, interest rate changes, or investor sentiment, they can rise and fall at the same time. This creates hidden vulnerability. True diversification requires combining uncorrelated or negatively correlated assets, investments that respond differently to various economic conditions. For example, when economic growth slows, equities may fall, but bonds can rise. When inflation surges, bonds may struggle, but commodities and gold typically increase in value. When currencies weaken, real assets may hold their purchasing power. Dalio refers to this as structuring a portfolio for multiple futures, not a single expected outcome. By owning assets that perform well in different environments, an investor reduces the impact of unpredictable shocks. The more uncorrelated assets one adds to a portfolio, the lower the overall risk becomes, without necessarily reducing returns. For Dalio, this principle is a foundation of long-term wealth preservation and protection in a world defined by uncertainty. If you'd like, I can expand point 3 next, or help assemble all expanded points into a fully polished document. You said expand point 3 into 600 words. ChatGPT said absolutely. Here is a 600-word expanded version of point 3. Prepare for all economic seasons, BR. Prepare for all economic seasons, BR. Knee of Ray Dalio's most influential contributions to investing is his framework of economic seasons, distinct environments driven by changes in growth and inflation. Just like weather seasons, these conditions are cyclical and inevitable, but their timing can be unpredictable. Dalio stresses that rather than trying to forecast what season comes next, investors should prepare for all of them. Dalio identifies 4 major economic seasons. 1, rising growth with low inflation. This is the classic bull market environment. Economies expand, productivity increases, unemployment drops, and corporate profits rise. Equities and riskier assets typically perform very well in this phase. Consumer confidence is strong, central banks keep supportive policies, and technological innovation accelerates progress. Dalio ensures that his portfolios maintain exposure to assets like equities so that investors can benefit during these prosperous periods. 2, falling growth with low inflation. This is a recessionary or deflationary period. Demand weakens, companies struggle, and unemployment rises. Interest rates often fall as policymakers attempt to stimulate growth. In such times, long-term government bonds shine because lower interest rates increase their value. Dalio positions bonds as a safety net, protecting the portfolio when economic contraction hurts business profits. 3% rising growth with high inflation. This season can appear healthy at first because the economy seems active, but excessive inflation erodes purchasing power. Traditional equities may struggle because rising costs eat into company margins and consumers become cautious. Here, commodities and real assets tend to excel. Prices of oil, metals, and agricultural goods rise in response to inflation. In Dalio's strategy, these assets serve as inflation shields, ensuring purchasing power is preserved. 4, falling growth with high inflation, stagflation. This is the most difficult environment. Economic stagnation paired with high price increases. The 1970s serve as a classic historical example. Stocks fall due to weak earnings and bonds lose value due to higher interest rates. In such rare but damaging environments, gold becomes a critical hedge. It retains value when confidence in financial systems weakens. Dalio views gold as insurance specifically for these painful and unpredictable times. Why this framework matters? Dalio believes investors often make a dangerous mistake. They assume the future will look like the recent past. When markets are booming, many overweight stocks, forgetting that downturns eventually arrive. When inflation is low for years, they may ignore assets like commodities until inflation spikes, and then it's too late. Dalio's view is shaped by centuries of economic history and the behavior of empires and financial systems. He emphasizes that dramatic economic shifts, currency debasement, debt crises, political transitions are more common than people like to believe. The only way to avoid being caught unprotected is to build resilience in advance. How Dalio applies this principle. Instead of making predictions, Dalio constructs the all-weather portfolio, where asset classes are deliberately selected so that at least one major portion of the portfolio performs well in any economic season. The idea isn't to maximize profits during good times, but to avoid large losses during bad times, because recovering from deep losses is far harder than modestly growing wealth. This creates emotional stability too. When portfolios are prepared for turbulence, investors avoid panic-driven mistakes, such as selling at market bottoms. Conclusion: preparing for all economic seasons means embracing uncertainty as a constant. Rather than betting on one future, Dalio teaches investors to respect the complexity of the global economy. Growth and inflation will rise and fall, sometimes gradually, sometimes violently. By allocating assets to address every possibility, investors gain the confidence that their wealth is protected and positioned to grow, no matter what the next season brings. Long-term treasuries as a deflation hedge, long-term government bonds, particularly U.S. treasuries, occupy a cornerstone position in Ray Dalio's all-weather portfolio. While equities drive growth and commodities hedge inflation, long-term treasuries serve as a protection against deflationary environments, offering stability when other assets are under stress. Dalio's analysis of economic cycles shows that markets do not move in a straight line. Economies experience periods of slow growth, recessions, and even deflation, where the value of money rises, but overall economic activity contracts. In such scenarios, equities often fall and riskier assets suffer. Long-term treasuries, however, typically rise in value when interest rates decline in response to economic weakness. This is because bond prices move inversely to yields as central banks lower rates to stimulate growth. Existing long-duration bonds with higher coupons become more valuable. Moreover, treasuries are considered the safest financial asset in terms of credit risk, backed by the full faith and credit of the U.S. government. This makes them a reliable store of value during periods of market panic or deflationary shocks, providing liquidity and reducing portfolio volatility. Dalio emphasizes that their role is not for high returns, but for risk mitigation. a financial anchor that helps preserve capital during turbulent times. Long-term Treasuries also complement other elements of Dalio's risk parity approach. While they may not perform strongly in inflationary periods, their anti-correlation with equities and commodities ensures that a portion of the portfolio gains when other parts lose, smoothing overall returns across economic cycles. In essence, long-term Treasuries are an essential hedge, helping investors weather deflationary storms while maintaining the portfolio's structural balance, resilience, and long-term stability. Maintain liquidity and flexibility. Ray Dalio emphasizes that liquidity and flexibility are essential components of a resilient investment strategy. While growth and hedging assets like equities, bonds, and gold are crucial, having a portion of the portfolio in liquid, cash-like instruments allows investors to respond to unexpected opportunities or risks. Dalio often describes liquidity as the ability to act decisively when markets shift, whether that means buying undervalued assets during a downturn or adjusting allocations to manage risk. Liquidity also serves as a buffer during market turbulence. In times of high volatility, having cash or cash equivalent assets prevents investors from being forced to sell other holdings at a loss. This stability reduces emotional stress and prevents reactive short-term decisions that can undermine long-term strategy. Moreover, flexibility ensures that the portfolio can adapt to changing economic regimes. Markets are influenced by interest rate changes, geopolitical events, inflationary pressures, and technological shifts. By maintaining liquid reserves, investors can quickly reallocate capital towards sectors or assets positioned to benefit from the current environment. In Dalio's all-weather philosophy, liquidity is not a passive holding, but an active tool. It allows the portfolio to be nimble, resilient, and ready to capitalize on opportunities while minimizing exposure to risks that could otherwise erode long-term wealth. Systematic, rule-based investing. Ray Dalio emphasizes that successful investing is less about guessing the future and more about creating a systematic, rule-based approach that responds consistently to changing market conditions. He believes that emotions like fear and greed often lead investors to make impulsive decisions, selling at market lows or buying at highs. By following clear rules and principles, investors can avoid costly emotional mistakes and maintain discipline during turbulent periods. Dalio applies this philosophy through structured processes like the all-weather portfolio, which uses specific allocations and risk balancing rules to ensure that no single asset or economic scenario dominates the portfolio's performance. Every investment decision is based on research, historical patterns, and macroeconomic analysis rather than speculation or short-term trends. A systematic approach also involves regular rebalancing. When certain assets outperform, their weight in the portfolio increases, potentially skewing risk exposure. Dalio's method ensures that assets are adjusted back to maintain balance, keeping the portfolio aligned with its long-term goals. Ultimately, rule-based investing is about predictable resilience. By combining discipline, research, and predefined strategies, investors can grow wealth steadily while mitigating risk. Dalio's philosophy teaches that a systematic approach turns uncertainty from a threat into an opportunity for long-term success.